Government financing programs and regulations. The federal government has several programs that encourage home ownership by making home loans more affordable. These programs do not make loans, instead, they encourage lenders to make affordable loans by ensuring affordable loans to be made qualified. These programs do not make loans, instead, they encourage lenders to make affordable loans by ensuring affordable loans made to qualified home buyers. Conventional loans are loans that are not part of these programs. How do these programs make loans affordable? The main way is by allowing borrowers to use more leverage or borrowed money that a bank would normally allow. Banks typically want a loan-to-value ratio of no more than 80%. This means that the borrower must have at least 20% of the purchase price in cash and can borrow up to 80% from the bank. Since 20% cash is difficult for homeowners to come up with in many markets, the government ensures lenders that make loans under certain lending programs so that borrowers can make a smaller down payment. Lenders are willing to do this because with the insurance, the lender effectively still has the 20% down without the borrower actually needing the 20% down in cash. For example, 3.5% from the borrower and 16.5% insured by the US government. There are three main programs you should be aware of. Federal Housing Administration financing. The Federal Housing Administration was created in 1934 as part of the New Deal. The FHA insures lenders that make loans with more than 80% LTV for home buyers. Loan to ratio value. With more than 80% loan to ratio value for home buyers. And puts in place limitations to make loans more friendly to borrowers. Lower FICO requirements, higher debt to income ratios, and no prepayment penalties. Under the 203B program, anyone qualifies for FHA financing so long as they are purchasing a primary residence. Generally, these loans are for 1 to 4 family owner occupied homes that are under FHA's purchase price limit. This limit is determined based on the county where the home is located. Also note that any FHA loans originating before 1989 are assumable. Remember, the FHA only insures the loan and charges the borrower for the insurance. They do not make the loan. Qualified lenders make the loan, and market conditions dictate the interest rate on the loan. The insurance for FHA loans is called mortgage insurance, or MI. Veterans Affairs financing. Veterans Affairs financing is like FHA financing, and is available for honorably discharged veterans, those who have served in the National Guard or Reserves, service members on active duty, and spouses of service members who died while serving or due to service-related disabilities. It was established in 1944 as part of the GI Bill and is provided by the Department of Veteran Affairs. The rules work more or less in the same way as an FHA, except that no down payment is required. There can be a financing fee, but veterans are allowed to roll the fee into their loan. For the purposes of the exam, VA financing is the only no down payment loan available to borrowers. Like FHA, the VA only insures the loan. Qualified lenders still make the loan. Veterans may reuse VA financing several times, but may only have one loan in their name at any time. Similar to FHA 203K loan. there's a VA renovation loan program that allows borrowers to include renovation costs in when purchasing or refinancing. VA loans originated before 1988 are assumable. USDA financing. The United States Department of Agriculture offers loans, grants, and loan guarantee programs to low and moderate income rural Americans who would like to purchase a home and or farmland. Funding can also be used for home improvements in rural areas to bring them into compliance with building and sanitary codes. The USDA Multifamily Housing Program offers rental housing loans that provide affordable multifamily rental housing for very, very low and moderate income families, as well as the elderly and those with disabilities. The USDA, through Farm Service Agency, provides loans to new farmers and ranchers who would otherwise be unable to obtain traditional financing for their farms. The USDA Rural Development Section 504 Repair Program offers loans and grants to low-income homeowners to make necessary repairs, improvements, or modernizations to their home. It's not for purchasing a new property, but it can help with rehabilitating an existing one. Private Mortgage Insurance, PMI. Private mortgage insurance is the private market version of FHA or VA financing. It is an insurance for the lender provided by a private insurer rather than the government. With PMI, buyers can make a down payment of less than 20%, but they must pay a monthly insurance premium on behalf of the lender until their LTV dips below 78%. At 78%, the PMI will automatically discharge per the Homeowners Protection Act of 1998. Private mortgage insurance is sometimes referred to as MGIC financing, since MGIC is one of the largest private mortgage insurance providers. Monetary policy. Monetary policy has a real impact on the pricing and availability of credit and consumer purchasing power. Since credit and purchasing power directly affect consumer demand and thus home pricing, it is basic understanding of monetary policy is critically important to understand why real estate values change. The Federal Reserve, also known as the Fed, created in 1913 in response to the Panic of 1907. The Federal Reserve was established with the goals of maximizing employment, stabilizing prices, and moderating interest rates. Over time, it has further expanded to regulate banks and conduct of much of the nation's monetary policy. It is very basically the bank's bank. When a bank needs a loan, it can turn to the Fed. It is private but has congressional oversight. While the Federal Reserve has many powers and authorities, we are primarily concerned with three: the federal funds rate and the discount rate. The federal funds rate is the rate for interbank lending. The discount rate is the rate which the Fed loans to the bank. Since these rates are effectively the cost of money for banks, it has the effect of setting the floor on interest rates. The theoretical lowest rate charged by the banks to their best customers is called the prime rate. It floats higher than the Fed's fund rate, so even at the best possible rate, consumers still receive a higher interest rate than the banks do. This also means that small changes in Fed fund rate can have significant impacts on the interest rates throughout the economy. The reserve requirement. How much banks must maintain on hand as cash reserves for their deposits and other liabilities. The higher the reserve requirement, the less lenders can lend. The lower the reserve, the more they can lend. This impacts the availability of credit. Also note that borrowing at the federal funds rate can be used to maintain these reserve requirements, which is a part of why they're so important. Federal Open Market Committee, FOMC, the buying and selling of U.S. debt to and from Fed member banks. The more FOMC buys, the more money is available for banks to lend out, and vice versa. This also stabilizes the cost of borrowing for the U.S. government. Lending regulations. The Real Estate Settlement Procedures Act, TILA, RESPA, and Dodd-Frank. The Real Estate Settlement Procedures Act is a federal law that requires lenders to provide borrowers with information on closing costs for financing for 1 to 4 family residential homes. It also prohibits certain kickbacks, referral fees, and unearned fees. Under RESPA, the lender is responsible for reporting the transaction to the IRS. Affiliated business arrangements, ABAs, where brokerages and mortgage companies, title companies, home inspectors, or other service provider package services together are permitted under the RESPA if the firms share at least 1% common ownership. The consumer is fully informed. The consumer is not required to participate in the ABA. Other providers are made available to the consumer, and the only thing of value returned is payment for the services and providers made available to the consumer, and return on 1% or greater ownership interest. In plain English, this means that the only compensation a broker may receive as part of an ABA is payment for any services rendered on the behalf of the ABA, listings and selling a home, and the distribution of profits based on how much the ABA broker owns. They can't get any additional fees beyond that, for example, a consulting fee or referral fees. Under RESPA, banks need to provide a bona fide estimate of the amount and range charges for real estate settlement closing. A uniform settlement statement from the Department of Housing and Urban Development was used before October 2015 to list all details of the transaction. As of October 2015, the Dodd-Frank Act and Consumer Financial Protection Bureau have changed some of the RESPA requirements and processes. RESPA now uses the TILA-RESPA integrated disclosure forms, which combined many of the Truth in Lending and Real Estate Settlement Procedure Act rules. A loan estimate form detailing estimated settlement costs must be given to consumers no later than 3 business days after the loan application and at least 7 days before the closing date. This gives the lender enough time to mail the loan estimate form if the consumer doesn't acknowledge receipt of the form within 3 days. Consumers must also receive a closing disclosure detailing the actual costs of closing no later than 3 days before the date of closing. If the closing disclosure is not available 3 days before the closing usually must be delayed. Changes to the loan or changes to the interest rate of more than 1/8% trigger a new 3-day waiting period. Proration. If there's any expense prepaid or unpaid at closing, or income that must be divided between a buyer and a seller, it will be prorated and reflected on the closing disclosure. Prepaid expenses are a credit to the seller and a debit to the buyer. Conversely, unpaid expenses would show as a debit to the seller and a credit to the buyer. For example, if the seller pays for the property taxes for the full year on January 1st and the closing is on June 1st, then the seller is credited the property tax for the amount of time for June through December, and the buyer is debited for that amount. On the other hand, if a repair or upgrade is needed, then the seller may be debited for the cost, while the buyer is credited. The math for proration is fairly straightforward. However, you should note that the exam will specify if the buyer or seller owns the home on the date of closing, and the exam assumes a 360-day year unless otherwise specified. Also note that property taxes run on a fiscal year from July 1st to June 30th. Finally, note that unlike other payments, a mortgage interest is paid in arrears, not in advance. So a mortgage payment made on June 1st is for May's interest, not for June's. Truth in Lending Act. The Truth in Lending Act, also known as Regulation Z or TILA, is a law enforced by the Consumer Financial Protection Bureau. Its purpose is to provide consumers with full disclosure of the costs of credit. This gives the public a way of comparing various lenders. To achieve this, TILA requires lenders to calculate their costs of credit and express them as an annual percentage rate if they advertise specific loan terms. It also allows a consumer to cancel certain loans within 3 business days. APR includes the interest rate, points, loan fees, finder fees, and a disclosure of any mortgage penalties. The APR does not include municipal taxes and attorney fees, credit reports, appraisal fees, survey fees, and other closing expenses. As a rule of thumb, if some third party is charging a fee, it is not included in the APR. Note that APR disclosure requirement is only triggered if specific loan terms are disclosed. For example, 3% down payment. It is not triggered if the lender uses vague terms that do not include a specific loan term. For example, liberal financing or loan down payment. The law covers any persons advertising consumer credit in their ordinary course of business. It covers all forms of advertising. It does not cover seller financing, commercial loans, or any other non-consumer credit. Real estate agents who advertise loan arrangements for a referral fee fall under TILA. The Equal Credit Opportunity Act, passed in 1974, ECOA, prohibits discrimination in lending similar to the Fair Housing Act's protections for real estate and requires that credit applications only be considered on the basis of income, stability, and the source of that income, net worth, and credit rating. ECOA protects against discrimination based on race, color, religion, national origin, gender, including sexual orientation, age, marital status, public assistance status. The term redlining is used to refer to any type of credit discrimination. Under ECOA, it is legal to make lending decisions based on factors other than the protected classes listed in the Act. For example, lenders may make or deny loans based on credit score, income amount, source of income, or debt-to-income ratio. Predatory lending. Predatory lending is unfair, deceptive, or abusive lending. It occurs when lenders fail to disclose loan costs, risks, and steer borrowers toward unfairly high interest rates, frequently refinancing loans to generate fees, loan flipping, or bait and switch borrowers. Laws like TILA are meant to prevent predatory lending. Usury. Usury occurs when someone charges an illegally high rate of interest. Usury laws outlaw usury in many states, but the Depository Institutions Deregulation and Monetary Control Act exempts many mortgages from state usury laws. Tax concerns. The United States Department of the Treasury was established in 1789 to manage government revenue and pay the cost of running the federal government. It has 3 main ways to pay for the U.S. operations, each of which has a drawback for the economy. Raising revenue. The Treasury Department can raise money by charging taxes. However, this directly removes money from the economy, reducing the purchasing power of the U.S. citizens. Borrowing. The Treasury can borrow to pay for the cost of the government by issuing government securities, bills, notes, and bonds. However, by borrowing, the U.S. government competes directly with its consumers for loans and increases demand for them, potentially raising interest rates. Most critically, this can have the effect of crowding out private borrowers, making credit less free or easily available to those borrowers. Printing money. The Treasury Department can print money to pay for the U.S. government debts. However, since money is affected by supply and demand, printing more money reduces the value of money. Inflation. Real estate sales must be reported to the IRS on a 1099-S form by the lender or escrow agent. 15% of proceeds of a sale on a property by non-citizens must be withheld by the buyer and forwarded to the IRS under the Foreign Investment in Real Property Tax Act. Residential and investment properties are handled differently for income tax purposes. Investment taxes. Investment properties usually generate income. This means that their owners have an income tax liability. To reduce their tax liability, income property owners may write off depreciation. Depreciation is a loss given to you by the IRS, calculated based on the economic life of a property, 27.5 years for residential, 39 for commercial. Depreciation can only be deducted from rental income or other passive income. Depreciation and other investment property losses cannot be deducted from active income, like salary, unless the property owner qualifies as a real estate professional. Note that only improvements may be depreciated. Land may not be depreciated. As a rule of thumb, about 20% of property value usually is land value. When an investment property is sold, its owners must pay capital gains tax on the profits from the sale. Capital gains can either be short-term or long-term. The long-term capital gains tax ranges from 0 to 20%, depending on the seller's income for the year. Any depreciated value that is made back at the sale will be subject to a depreciation recapture tax of 25%. 1031 like-kind exchanges. A 1031 exchange is a way to defer the payment of capital gains taxes. It helps to alleviate the disincentive for business growth created by the tax code. 1031 exchanges are called like-kind exchanges because the property owners must reinvest the proceeds from the sale of a property into the same type, another piece of real estate, within approximately 6 months in order to defer their taxes. The exchange does not need to be simultaneous, but it needs to be done within a time limit. This may be done multiple times, but remember that 1031 exchange defers the taxes, but it does not eliminate them. They are still due if the property owner ever makes a profit when selling the property. Similarly, losses are deferred along with the gains. When the seller sells the property, if they do not fully replace the value of the property by buying a new one, or if they reduce their mortgage debt, they will pay taxes on the unreplaced value or reduced debt. Residential taxes. Residential taxes are much simpler than investment taxes. Residential homeowners may write off the mortgage interest deduction and their municipal property taxes. Note that the mortgage interest deduction is only available if the property qualifies as a primary residence. The deduction allows homeowners to write off a portion of their mortgage interest calculated based on their tax bracket. Some second homes or vacation homes can qualify for mortgage interest deductions, but they must meet certain tax guidelines. It's best to discuss qualification guidelines with a tax professional. When it comes to profits on a sale, a portion of the profit of your primary residence is sheltered from capital gains tax per the Taxpayer Relief Act of 1997. The extent of the shelter depends on your marital status. Single taxpayers, $250,000 profit on sale sheltered from capital gains tax. Married taxpayers have $500,000 profit on sale sheltered from capital gains tax. Okay. And that was government financing programs and regulations.